We're certainly happy to see the price appreciation. But to me, when gold's at 5,000 and 10,000, and it will be, as Egon and I always say, be careful what you ask for because everything else is going to be so much more expensive. And that's the key to understanding precious monetary metals is the middle class, the retail investor who has trusted their wealth advisors, who has trusted their fiduciaries, their treasury secretaries, their central bankers, their leadership, red or blue, left or right. That leadership is rigged to fail. It's always the middle class who gets shafted first. And it's always in the name of something that's beyond the government's control. No, this is very, very deliberate. The first to benefit from inflation is always the top 10% because that money goes into asset classes like stocks and real estate, which the wealthy already own. The middle class, the bottom 90% get stimmy checks, and then they look at their checking account and their saving account and their salaries, which are measured in dollars, which are melting ice cubes, and they always get shafted. And they don't even know why. They just feel themselves getting poorer. They still have the same dollar, but the dollar buys less. That's a crime, and it's not discussed enough. It's disgusting.
Gold's rise toward $5,000 and eventually $10,000 will not signal prosperity. It will mark the unraveling of faith in fiat currency. The illusion of stability built by central banks and political leaders is cracking under the weight of decades of monetary manipulation. Inflation has always been the hidden tax, enriching the top 10% who own the assets while quietly destroying the purchasing power of everyone else. The middle class, trusting their governments and financial advisors, is the first to suffer, watching their savings melt while the cost of living explodes. Gold doesn't rise because the world gets richer. It grows because paper money loses value. And this time, the loss is global, accelerated by years of reckless quantitative easing and debt monetization. MatthewPiepenburg, partner at Matterhorn Asset Management, explains why gold's ascent is not a celebration, but a warning. It represents the failure of policymakers, the corruption of currency, and the betrayal of the very class that built modern economies. As trust in fiat evaporates, nations, institutions, and individuals are all returning to the one asset that cannot be printed, inflated, or destroyed: real money. The irony is apparent. The same system that mocked gold as a barbarous relic is now being exposed by it. Now, we present the clips from MatthewPiepenburg's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
You can't print gold. You can't create more of it when needed. You can't debase it. It's literally indestructible. I mean, it's almost biblical in the sense that it was here before the universe was created. There was I saw Alistair MacLeod just a few weeks ago in England. I remember he was telling about this. I mean, it was literally there. It's literally there before we were here. And it has a limited supply. Unless a meteor comes from outer space and there's suddenly a massive oversupply of gold, it holds its value better than paper money. And because it can't be created at will or debased at will by politicians, sovereigns, monarchs, kings, democratically elected, or czars, it will always be a better store of value than a denarius or a paper money or anything that can be debased or devalued. And I think it has that kind of historical fixed supply. People could argue Bitcoin's the same way with its fixed supply, but gold is on the periodic table. It doesn't rely on electricity. It doesn't rely on hash protection. It doesn't rely on technology. It just sits there and does nothing, as Buffett says, but stare back at you. It's this pet rock. It's this historic relic. But no, it's far more than a pet rock or an historic relic. It's always been sound money for millennia. It goes way past ancient Rome. It goes back to the Persian first trading huts. It goes back to the Ming Dynasty. Whenever a sovereign, a monarch, a king, etc., gets itself into the back against the debt wall, the citizens and the powers that be will naturally lead towards something that holds its purchasing power, holds its value because of its fixed supply, its indestructibility. It's literally in our DNA. We have a small amount of gold in our bloodstream. There's something kind of supernatural about it, but it's honest. Unlike politicians, unlike policymakers, unlike treasury secretaries, unlike central bankers, gold just tells the truth. It does nothing but stare back at you and hold its value, while fiat money can be swapped, exchanged, debased, devalued, traded, exported, inflated, and all these things. It can be very busy losing its purchasing power, but gold just holds its value. And it's going up to these exponential levels only because fiat money, including the world reserve currency, is being debased at such exponential levels. So gold has almost a supernatural, historical, and inherent quality that's simply unmatched. And that's why it's in such demand, and it will always get the last laugh over dying fiat paper money. It just always does. Well, right now it's still clearly driven by central bank demand, especially in the West. And even Western central banks aren't really fully catching on. I was listening to a conference the other day with some Western central bankers in Europe and former central bankers and former ECB officials, which just literally speak from a playbook. It's almost appalling. They're still seeing gold kind of as a misunderstood asset. They're ignoring what the other banks of the world, the other, especially the Eastern central banks, who have a long history of being used to being the dog wagged by the tail of Western policymakers who've been exporting their inflation and their world reserve currency around the world to the detriment of everyone. That's the famous, John Perkins book, The Confessions of an Economic Hitman. This exported inflation, this weaponized currency, which no one trusts, post 2022. Central banks have been quietly stacking gold since 2014. That increased dramatically after 2022 when we weaponized the world reserve currency against the advice of Robert Triffin and others. But now they're accelerating this. There's always been a distrust. I mean, you don't have to like China or Russia. You don't have to like the sanctions. You can like the sanctions. You can have your own views on Putin. But when we weaponize the neutral reserve asset, like the world reserve currency, trust in that already unloved U.S. Treasury and U.S. dollar increased exponentially. So the rise of the BRICS and the policies from the BRICS increased exponentially. The amount of net settling done outside of the dollar, the petrodollar, et cetera, that all increased at a rapid pace after 2022, as did gold stacking, tripled by central banks after 2022. That wasn't a coincidence. The jig was up. We'd gone too far with that. And so now the central banks in general, to answer your question, are by far the biggest buyers. It's kind of funny. I heard it was a Peter Schiff. The central banks see the writing on the wall because they literally created the wall. So they know that the currency is being debased by other central banks, certainly by the Fed. They know that we're in a debt corner. They know there's nowhere to go but down for fiat money. So the central banks, the very criminals who created this situation, especially now, are the first to be buying it, especially in the East. What's ironic is the UK and the US, the biggest sinners, are the slowest to the table. They're still trying to play the game that they have the power with this dollar. And we should talk about people who believe in a strong dollar who make a case for it. The writing is on the wall. This fiat money is part of history. It is being debased at an accelerated pace. It's sad to me that more retail investors aren't catching on, mostly because for decades they've been told by their registered investment advisors and their bankers at Goldman Sachs or Morgan Stanley or the smaller banks. They've all been ignoring gold, saying gold was too volatile an asset, even though it's outperformed the S&P for the last 25 years. The last dance for the DXY will happen when there's another market sell-off. If this market ever does mean revert, like in 2008, there'll be a run to safety. There'll be a run to U.S. Treasuries, and there'll be a run to the U.S. dollar. And like in 2008, we could see a massive pullback in the gold price, like 30%, as we saw in 2008. So he's basically using 2008 as an example. And that's a valid point, but I think what's wrong with that is 2025 and the gold role today is very, very different than 2008. The BIS has made gold a tier one asset. The IMF is talking about gold. It is not 2008. So when there is, or if there is, an uh-oh moment in this otherwise immortal stock market, which is monetized by the Fed and money printing liquidity, if there is an uh-oh moment, it will not be like 2008. There won't be the U.S. Treasury will not be the tier one safe haven lifeboat that it used to be in 2008. And the U.S. dollar won't be, again, for that whole string set of reasons we've just seen. The world doesn't trust the U.S. 10-year. It doesn't trust the U.S. dollar the way it did in 2008. So I don't see it the same way. No, I'm saying the market crash could be worse, but the gold price is not going to go down. It's going to go up because the money's not flowing to the dollar. It's flowing to gold. It's already pre-flowing, preparing right now. I'm a wealth preservation guy. Our entire business is wealth preservation. But look, we're certainly happy to see the price appreciation. But to me, when gold's at 5,000 and 10,000, and it will be, as Egon and I always say, be careful what you ask for because everything else is going to be so much more expensive. And that's the key to understanding precious monetary metals. When gold is at 10,000, a loaf of bread is going to be a lot more. And that's what's sad because the middle class, the retail investor, who has trusted their wealth advisors, who has trusted their fiduciaries, their treasury secretaries, their central bankers, their leadership, red or blue, left or right. That leadership is rigged to fail. They always debase the currency. it's always the middle class who gets shafted first. And it's always in the name of something that's beyond the government's control. No, this is very, very deliberate. And inflation is not class blind. The first to benefit from inflation is always the top 10%, because that money goes into asset classes like stocks and real estate, which the wealthy already own. So when you QE to the moon, that rips up the stock market. The wealthy get wealthier. The middle class, the bottom 90%, get stimmy checks, and then they look at their checking account and their saving account and their salaries, which are measured in dollars, which are melting ice cubes, and they always get shafted. And they don't even know why. They just feel themselves getting poorer. They still have the same dollar, but the dollar buys less. That's a crime, and it's not discussed enough. It's disgusting.
Silver stands at the crossroads of affordability and opportunity, the one asset still within reach for ordinary investors, yet positioned for extraordinary gains. With supply deficits deepening and industrial demand surging, the stage is set for a powerful revaluation. As global trust in fiat currency erodes, silver's dual role as both an industrial metal and a monetary refuge makes it uniquely compelling. Its market cap remains minuscule compared to global capital markets. Even a modest reallocation from stocks or bonds could send prices soaring. The current suppression through short positions on Western exchanges is cracking under physical demand, signaling a coming shift from paper promises to real metal. Meanwhile, a new financial layer is forming through stablecoins and digital assets, instruments that create artificial demand for U.S. treasuries, but also expose users to hidden risks of control and devaluation. In this landscape, tangible assets like silver remain the only proper defense against digital and monetary debasement. Let's get back to the interview.
People always say silver is the poor man's gold. I think it's the smart man's silver. And I think it's probably the most undervalued hard asset, and certainly the most undervalued precious metal. Platinum's another interesting case. Silver, to your question earlier about what do retail investors do or what can they do, I have to be very respectful that many listeners here don't have $37,000 or $4,000 to buy an ounce of gold, and they feel like they've missed out. And they're trying to get through the month with mortgages, rent, tuition, or whatever. How can they possibly protect themselves? How can they take advantage of this open destruction of fiat money and protect themselves if gold feels too out of their reach? And to your point, silver, I think, is the ultimate opportunity for those that are struggling to try and find a way to protect themselves right now when gold or an ounce of gold feels too expensive. Look, it's up more than 60% this year. We're not at the 1980 or 2011 gold-silver ratios of 15 and 32, but there is a clear indication that there's a massive supply deficit in this metal. I mean, you've got open pit restrictions in Mexico, et cetera. The market cap for silver is like literally it's half of NVIDIA, for God's sakes. I think it's a $2 trillion market cap. So there is any even measurable increase in demand for silver will send its price up significantly. And it's certainly, you've got guys like David Bateman buying a lot of silver right now. I don't think it's because they're just speculating. They see an opportunity for massive 5x, 6x, 10x price appreciation, but it's a way to protect themselves in a precious metal that's affordable. And I think the fact that you've seen so many shorts on the otherwise dying COMEX or the LBMA exchange in London, and despite the shorts, silver's knocking at the door of all-time highs. And because of its limited supply and because of its small market cap, I see a massive opportunity for silver. Again, I think it's the most undervalued asset in dollar terms or even priced in gold terms right now. And again, we're seeing huge interest in silver at our desk in Switzerland. It's not by accident. It's not just by desperate speculators. It's by people who see a massive price appreciation, but a precious metal that's actually affordable, especially for the man on the street, which is incredibly important. But I think if you're looking at silver, remember, you've got to have a long-term view. It's not just a speculation asset. It's a monetary metal. You have to hold it with a sense of insurance for dying paper money. And just like gold, you don't want to just trade it for a 2x return. You've got to be patient. As Rick Wool said, silver rewards infrequently but extravagantly, and silver is positioned right now for some fantastic return. I think it's like, again, it's always the inverse of the dollar. And since the U.S. is broke quantifiably on its balance sheet, as Hemingway described, poverty is happening slowly then all at once. It's going to be the same thing with the disintegration of the dollar, slowly then all at once. the gold price has been knocking from 1,600 to 2,200 to 2,500 to 2,800 to 35. It's slowly, then all at once. It'll be particularly the case for silver, which is like that little speedboat next to the juggernaut that is gold. When gold is hitting all-time highs and when gold is in a bull market, silver tends to dramatically outpace in terms of its speed of movement. I don't think gold's even in its bull market yet. We're clearly at a turning point, but gold is just in the first or second chapter. And I think the reason silver hasn't fully caught up, other than the mechanizations on the COMEX, etc., which is disintegrating, one of the reasons silver hasn't really seen that compression of the gold-silver ratio is because really the gold bull market is just beginning. And as it gets more traction, as it becomes more obvious, then I think silver, in terms of just pure price appreciation, is going to be a massive move. And so I'm highly recommending silver as an allocation, and I'm not alone. To me, the Genius Act should be called the Desperation Act, but it's more than that. It's an insider trade. It's an insider trade to devalue the US dollar, export US inflation, enrich fintech like Tether and Circle Internet, and also enrich Uncle Sam and we'll explain why, but shaft the dollar holders. Because what they're doing is they're stuffing a bunch of US dollars into stablecoin. And we've seen this movie before of devaluing the dollar. And the idea is you, the man in the street or the guy in Argentina or the Turkish central banker or the Turkish doctor need US dollars because it's better than your local currency in Argentina or Turkey. So we'll throw you into this stable coin. You'll have now an e-dollar. Meanwhile, Circle Internet, Tether, JP Morgan, etc., the issuers of this get to take your dollar, invest it in T-bills. They have to, by law, invest it in US treasuries. So they get a yield, which they're making billions on as we speak. The holder of the stable coin gets nothing. They get an e-dollar linked to a treasury, which is volatile, which has 3 sigma moves, which is not stable and it's not a coin. But the issuers make a fortune. Uncle Sam wins because, look, this is fantastic. I got new demand for my unloved, untrusted, unwanted U.S. Treasury. And I got new demand for the U.S. dollar. And Bessent is looking to try and stuff this, the stable coins, get 3.7 trillion worth of these in the next 3 to 4 years, because that's a sign of how desperate Uncle Sam is. They need to create this stable coin to create artificial or direct demand for an otherwise unloved dollar in U.S. Treasury because no one else wants the U.S. Treasury. And I think, as Anton Kobayakov says in Russia, love him or hate him, that they're really doing this deliberately so they can inflate the amount of dollars coming into stablecoin, eventually debase the dollar, debase stablecoin because there's more control of that, and then revalue gold higher to help Uncle Sam get out of debt. That certainly helps Uncle Sam. It certainly helps Tether. It certainly helps Circle Internet. It certainly helps JP Morgan. It does not hold the sucker, the newest sucker, to buy the stablecoin and create demand for this dollar. But it's perfect timing for a perfectly desperate government and a perfectly insider trade. To me, the Genius Act was a kingmaker. It's an insider trade. We all know the parties behind it. Whenever I hear Marcia McLennan come up or some of these names that are behind it, I know there's something wrong. But look, again, it's kind of a Halliburton-like trade. It benefits the minority. It really screws the majority who are buying them. It helps Uncle Sam. It doesn't change the fact that the dollar is still going to be devalued. And it doesn't change the fact that we'll probably revalue gold at some point much higher. But those are all separate silos. But no, stablecoin is not stable. It's not a coin. It's an e-dollar. And it is just as trackable, programmable, and seizable as a central bank digital currency. Instead of coming from a central bank, it comes from a fintech company. And that's it. That's the only difference.
Silver's moment is arriving faster than most realize. Decades of undervaluation, industrial demand growth, and monetary debasement have converged into a perfect storm. Unlike digital assets or manipulated paper contracts, physical silver represents something tangible, a scarce, essential, and irreplaceable store of value. As currencies weaken and confidence in financial systems erodes, silver is poised to reclaim its historical role as both money and protection against systemic failure. This is not a speculative trend, it's a structural awakening. The world is rediscovering what sound money looks like, and this time, it's shining brighter than ever. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.